Good afternoon, everyone. It is 3:30 Central Time in beautiful downtown Chicago. Thankfully, spring has finally arrived. It's a gorgeous day out, and it's a perfect day to learn about options, specifically hedging with options. My name is Mark Benzequin. I am an instructor here at OIC, the Options Industry Council, and I am also a principal of options education for our parent company, OCC. And today we're going to be talking about hedging with options, specifically a strategy called protected puts. Before we get to that, we've got some standard housekeeping to take care of. For those of you that are new to options, we want you to know that options involve risks and may not be suitable for everyone. As a matter of fact, those risks are outlined in a document called the Characteristics and Risks of Standardized Options. You can obtain an electronic copy on our website or a hard copy from your trading or brokerage firm. And in order to simplify the calculations and examples that we're going to be using today, we are going to be emitting real-world costs which impact your trade, such as commissions, fees, margin, interest, etc. And again, any of the strategies that we're discussing today are simply for illustrative and educational purposes and are not intended as a recommendation or an endorsement to use options. Some of the trademarks that you're going to see throughout today's presentation, those of the Options Clearing Corporation, again, our parent company, and the Options Industry Council. For those of you unfamiliar with the Options Industry Council, we are a unbiased professional organization where we provide free educational content regarding all things options. The bulk of our material is housed on our website, optionseducation.org, where we've got interactive online courses, monthly podcasts, hundreds of videos, and the monthly webinar program that you're attending today. We also have the pride and joy of OIC, which is our investor education department. You can reach us via email at options@theocc.com with your questions. You can also live chat with us on our website. And speaking of the investor education desk, I'm happy that one of my colleagues has joined me in the studio today, Mr. Matt Cashman. And Matt is going to be behind the scenes taking your questions and answering them in real time. Depending on the length of the presentation, hopefully we'll have time to get to some of your questions in a live Q&A as well. So let's go ahead and get right to it. Here's our outline for today. We're going to begin with a discussion of the basics of long puts, what it means to buy a put, and what the rights of a put holder may be. And then we're going to explain the concept of hedging, as well as an example of the protected put, which is today's topic. We're also going to look at using protected puts to protect your portfolio as opposed to an individual stock. And we're going to address one of the questions that we receive most often when we discuss protected puts, and that's how they differ from stop loss orders. Lastly, we're going to be looking at in comparing a protected put to a bear put spread, and then, as I said, we're going to take some Q&A. So let's go ahead and get started with the basics of long puts. When it comes to options, buyers have rights and option sellers have obligations. Now, with a put option, that right equates to the right to sell stock at our strike price. So, for example, if I've got a $50 put, I have the right to sell stock at $50 a share, regardless of where the shares may be at that time. And for that right, I'm going to be paying a premium, an options premium, or the cost of the trade to the option seller. Now, when I decide, or if I decide that I want to sell my contract at that strike price, I'm going to exercise. And exercise is the process by which an option buyer enacts his or her rights given to them by that option contract. So in the case of a long put, I'm going to pay my strike price times 100, and I'm going to deliver those shares. And actually, misspoke there. This slide is incorrect. When exercising the long put, I'm going to be collecting my strike price and delivering 100 shares of stock. Remember, I'm selling the stock at my strike price. So in this case, I would be collecting my strike price to do so, and I would be delivering those 100 shares of stock. So a very high-level overview of the rights of long put holders. We've got much more in-depth material on our website. If you have any questions about the rights and obligations of buyers and sellers, please feel free to reach out to us. When it comes to hedging, hedging is a risk management technique that investors use to offset losses. Now, what that means is that if I've got an investment that I may be overly invested in, you can see here we're talking about, and actually that's on the next slide. And ladies and gentlemen, I apologize. I'm feeling a little bit under the weather. I'm actually, my wife tested positive for COVID yesterday, and we've got a little bit of illness in the house here, so I apologize if my thoughts aren't as clear and fluid as they usually are. But that being said, when it comes to hedging, hedging is a means of protection that investors may use by taking an opposing position in possibly a related financial product. So, for example, if I owned stock and I'm worried that the stock price is going to go down, remember, when you buy stock, obviously you're bullish. You want that stock price to go up. But if it doesn't, right, your risk is that the share prices will drop. So you can hedge that stock by using another instrument. In this case, we would be talking about a put. Now, the thing about hedging is that once things go south on you as an investor, you can still hedge, but the cost of that hedge is going to be significantly higher. So there's a saying that we have on the trading floor: hedge when you can and not when you have to. But by doing so, by hedging, and in the case of a protected put, we've got our long stock. If stock goes up $1, we make $1. Stock goes down $1, we lose $1, right? That's, a fairly understandable concept for investors. But when we hedge, we are taking a position in another financial instrument to protect ourselves, and typically we've got to pay for that protection. And by doing so, that is going to reduce our not only our risk, but it's also going to reduce our lower overall profit as well. So why would we hedge? Well, for example, what if our market outlook gets changed? Let's say we bought stock, we're bullish on the stock, we think it's going to be going up, but maybe something happens and now the stock is starting to trend downwards. We may not want to sell that stock for whatever reason, whether it be tax purposes or if we still maintain an overall bullish outlook on that security in the long run. But maybe our market outlook has changed in the short run. So we might want to hedge our stock, hedge our position. Maybe we're overly invested in one asset. You can see here the adage that everybody's familiar with: too many eggs in one basket. If we've got a lot of money wrapped up in a single investment, and that investment again goes south, well, that's not going to bode very well for us as an investor. So if we've got too many eggs in one basket, we're overly invested in one specific asset, maybe we would be looking to hedge. Or we're looking to protect gains in an existing profitable position. Let's say I originally bought stock for $100, and now it's trading $120. So I've got a $20 profit built into that position. Maybe I want to lock in some of that profit. So should the stock price drop, I can, maybe buy a 110 strike put or a 115 strike put and lock in some of that profit that way. Pardon me. Excuse me. All right, so let's go ahead and move on. So we're going to look at protected puts specifically here. A protected put is where we're pairing long stock with a long put. That long put provides us the downside protection for that stock position. You can see here we're saying that we're cautiously bullish. We want to own. I apologize. There's some background noise there. Matt, can you mute yourself, please? One second, folks. There we go. Thank you. So with that protected put, let's say we're cautiously bullish. We still want to own the stock. We think that it's got some room to go, but maybe in the interim, in the short term, maybe in the short term, we're worried about maybe an earnings announcement, for example, or drug trial results, or some congressional act, government act that might affect the security. We're bullish in the long term, maybe a little bit cautious in the short term, so we're looking to protect ourselves. That profit is still going to remain in the long stock position. So as stock prices increase, we're still going to profit. And that's the whole idea of the trade. We're cautiously bullish. We still want that stock to go up. So we still make money if it does. And then again, that strike price is going to determine the price at which we can sell that stock. Now, we may want to look at the amount of protection needed. Are we looking to protect all of our stock from, for example, the $100 where we bought it all the way down to zero? Are we looking to protect it maybe against the 10% downturn, something like that, protect some of our unrealized profit? So these are questions that you are going to want to ask yourself as an investor. How much protection do you need, and what is the cost of that protection? And that's something that we're going to get into in just a moment. So again, our protected put, our strike price determines the exit price. The long option, that gives us the right to exercise. And again, that's where we realize our rights to sell that stock. But we still have that potential for profit in the long stock. That's the whole idea. We're cautiously bullish. We still want that stock price to go up. And then it also might give us the ability to lock in some profit. So kind of a little summation of what protected puts are all about. And now let's go ahead and get into some more specifics. So when it comes to any option trade, whether we're talking calls or puts, buying or selling, it's going to be a balance of strike selection and expiration date. Now, our strike selection in this case is going to be how much protection do we need versus how much are we willing to pay. Remember, that strike is going to give us the ability to exit our stock at a specific point. So here, for example, we're long stock from $100. We're looking 60 days out to expiration, 25% implied volatility, 4% interest rates, et cetera. So this forms the basis of our trade. Here are some available strikes, and you can see with puts, the higher the strike, the higher the cost. The midpoint for the $100 put is about $3.75. So if we wanted to buy the 100 strike put, which affords us the right to sell our stock at $100 a share, we're going to be paying roughly $3.75 for that protection. If stock went down to, say, $50, we would likely want to exercise our put, sell that stock at $100 a share, but we're paying $3.75 to do it. So theoretically, we're selling our stock for $96.25. That would be the effective share price if we bought that $100 put. Now, if we go down to, for example, say the 92.5 put, and we were able to maybe buy that for, say, $1.10, if we were to exercise that put, we would be selling shares at 92.5 minus the 110 that we paid for is what, $91.40. So you can see the difference. We may be paying more upfront, $3.75 for this protection, but we're also selling our stock much higher than the lower upfront cost. So the thing to realize here is that it's not always what we pay upfront that's important. Obviously, this would only be necessary if stock was to decline. So, for example, if we bought that $100 put If stock got anywhere below $100, we might wish to exercise. With the 92.5 strike put, we likely wouldn't exercise until shares got below 92.5. So it's going to be a balance between how much protection we need and how much are we willing to pay for. Now, on the flip side, we've got our the expiration date. I'm sure everybody is familiar with the saying, time is money, and that happens with options as well. Typically, when people will do a protective put, they might do it for some specific event, a corporate event such as earnings release, as I mentioned, drug trial results, etc. And what you can see here is the further we go out in time, the more it's going to cost us. So if we assume that we selected to purchase the 90 strike put, if we were only looking for 15 days worth of protection, it would cost us maybe 36, 37, 38 cents, something like that. If we were to extend that protection out 3 months, it would cost us maybe $2.45. So the further we go out, the more it's going to cost the investor. So you're going to want to balance how much protection do I need, how much am I willing to pay for it, and for how long do I need that protection. Let's go ahead and look at an example that might give us a better idea. Here's a hypothetical scenario. We've got a fictitious stock, JetX, and our investor is bullish but cautious due to an upcoming government contract negotiation that's going to be happening in the next month. If the contract is approved, then it's expected that shares are going to increase by about 10%. If not, then the street is calling for a 20% reduction, and our investor is long shares from $80. So that's our setup. Here are a couple different scenarios. We've got the June puts with strikes ranging from $80 down to $70, and then an extra 30 days of protection again in July with strikes ranging from $80 down until $70. So if we assume that currently JetX is trading $85 and we are long stock from $80, we want to limit our downside risk, right? That's the whole reason that we're doing this trade. We're going to look to buy the July 75 strike put for $2.70 or $270 in real world costs. Now, again, this is just a hypothetical scenario. The investor is obviously, able to select whatever time frame they want and whatever strike price they want. However, the time frame really should incorporate the time horizon for that event to occur. If this event is occurring within the next, say, 45 days, then maybe buying 30 days worth of protection isn't the best idea because it doesn't incorporate that time horizon that we need for this event to happen. So that being said, here are some different scenarios. Again, we bought that July 75 strike put for $2.70. If at expiration, stock actually rallies a little bit, it goes from the current price of $85 and goes up to $90, then that put that we bought, that 75 strike put, is going to expire worthless, right? We didn't need that protection. And therefore, the option is going to expire without value. However, we still maintain that stock, so we made $10 on that stock from $80 where we're long to $90 where it currently is at expiration. And our profit and loss is going to be a profit of $7.30. We made $10 on the stock, but because our option expired without value, we lost that $2.70, and we've got $7.30 of profit and loss. If stock doesn't move anywhere from where it's trading, again, we're not going to need that protection. We're going to make $5 on the stock. We make $2.30 on the overall trade. And you can see here that the protection really only kicks in if stock finishes below our strike price. If stock finishes at $70, which is $5 below our strike price, we're going to exercise that put, or I should say, it would be expected that we would exercise that put. That put would have $2.30 worth of value, right? We paid $2.70 for it. It's now worth $5, so we've got a net $2.70 $2.30 value on that put. We lost theoretically $10 on the stock, and here's our loss of $7.70 overall. And if you were to extrapolate this from $65 all the way down to zero, you would see that $7.70 is going to be our maximum loss no matter how low that stock goes. For those of you that might have a better idea graphically of how options work, this is our profit and loss chart. Here's our long stock position at $80. Here's our maximum loss at $7.70, and that occurs when share prices finish below our strike price of 75. So if stock goes down to 70, 65, 50, what have you, you see that our maximum loss remains at the maximum. And yet if share prices climb beyond where we are long, we're going to make money. So this line extends out into infinity. As stock prices go up, so does our profit. Again, that break even at expiration, it's going to be $82.70. That is going to be the price at which we are long stock plus the premium that we pay for that option. So $82.70 is going to be our break even point. Anything less than that, we are going to profit. And then our maximum loss, again, $7.70. That's our share price plus the premium minus our strike. So that's how a protected put works, kind of, the nuts and bolts of a protected put. And this is specifically for a single stock. If we were looking to protect our portfolio as a whole, well, we can do that too. We've got a $100,000 portfolio, let's say, and it reflects a broad-based index or ETF. And this is generally a scenario that works best where our portfolio mirrors one of the larger indices or an ETF. And again, here's our hypothetical situation. We're cautious on the market for the next 90 days. We're looking to limit our downside risk beyond a 10% correction. And so we're looking to buy puts in a corresponding ETF that closely resembles the security that we have. So here are our calculations. We've got our $100,000 in our portfolio. We're looking to protect $90,000 of it, which would be 10% of 10% off of our total, I should say. And because it closely resembles an index, where we can use an ETF that mirrors that index, and in this example, we're going to say that that index costs, or I should say that ETF costs $400 a share. If we were to select the at-the-money strike, that would basically be us saying we want to protect our entire portfolio. We're not looking to withstand a 10% sell-off. We're not looking to withstand any sell-off of any kind. But because we're willing to accept a 10% reduction in value, but no more, we're going to look at the 10% out of the money put, which in this case would be the $360 strike. And the price of that put is going to be $3 or $300 per contract, again, when taking into account the multiplier. So here's our calculations. For those of you that were hoping math wouldn't be involved, I'm sorry to disappoint you. The formula that we use when looking to hedge our portfolio, we look at the total dollars that we're looking to hedge and divide that by the notional value of our strike price. So if we've got a 360 strike price, the notional value of that is $36,000. We're looking to protect $90,000 worth of investment. That comes out to 2.5 puts. Now, obviously, we can't trade half a put contract. So that would mean that in this example, we would either buy 3 puts to hedge our position, and 3 puts would actually come out to, about $98,000 of portfolio, or we would buy 2 puts, and at that strike would give us about $72,000 worth of protection. So it may be necessary, depending on what you're looking for, to maybe choose a different strike, choose a different amount you're looking to hedge, or be willing to hedge more or less. And that's the thing about options, that there may not be a scenario that fits in a neat little box, but due to the versatility of options and the flexibility, you're able to kind of move things around a bit and get to where you need to be. So we can buy more or less puts to hedge more or less of our position. And then again, in this example, it assumes that 1-to-1 correlation, meaning that the position that we have and our hedge mirror each other enough to where there's almost an exact correlation between the indice going up or down and our ETF going up or down. Now, I mentioned earlier that one of the questions that we receive often is, why not just do a stop loss order? And it's a good question, and stop loss orders can be a terrific way to hedge stock. As you can see here, the premise of the stop loss order is that it can help protect against a declining share price if shares drop below a set price. And we've got 2 different types of stop loss orders. There's a stop loss market order, a stop loss limit order, and both types of orders are triggered or enacted when that stock price falls to a price level predetermined by the investor. The difference between a protective put and a stop loss order is that the stop loss order is triggered when the stock drops below a certain level. So let's say, again, for an example, we own stock at at $100 per share, and that we are worried if stock drops below 90. If stock drops between $100 and $90, we're okay. We're willing to withstand the loss because we think that the stock might rebound. Maybe it's only a temporary dip in the share price. But if things drop below $90, we want out. So we could possibly do a stop loss order, and that would be the case. Once stock prices drop below 90, we either sell the stock automatically, that stop loss order gets triggered, and we sell stock automatically at the best available market price. That would be a stop loss market order. Or we only sell those shares once they hit $90 again. The problem with it is that stock can quickly go from $90 to $75 to $50, what have you. And if we had a stop loss limit order, that trade would never be enacted, and we still own those shares as the bottom drops out. The thing with a protected put, because we're a buyer, and as we said in the very beginning of this presentation, the buyers have rights, we are in the driver's seat. We control what happens. Maybe that dip is just temporary. Maybe we decide that we want to hold on to those shares and see what happens next. Look at it this way. Let's say we buy a put today or tomorrow, now that the market's closed, but let's say we go ahead and buy that 90 strike put and it's expiring 30 days from now. If stock let's see, today's Wednesday, let's say Friday, stock drops down to $75. If we had a stop loss order, that stock would be sold right away and our position would be liquidated. But what happens if next week stock then rallies to $85? And then the following week it goes to $105, and the following week it goes to $115, what have you. Had we had a stop loss order, we would no longer be owning these shares. Because we've got a protected put, we can decide when and if to exercise, which means we can participate if shares reverse and rally. There's no automatic trigger. Again, we are in control. Another difference between the two, though this is more in favor of the stop loss order, is that typically there is no expiration date. Typically there is no cost in putting on a stop loss order, whereas there certainly is with a protected put. So while both strategies have their advantages and disadvantages, this is just a brief explanation or an overview as to how the two strategies might differ. Protected puts versus the bear put spread. This is interesting, I think. We've got the protected put, and that gives us protection from the strike price all the way down to zero, okay, which is one of the great things about puts. It affords you the right of that protection. But what are the chances that the stock is going to go to zero? What if that stock price is only going to drop a little bit? So with the bear put spread, it's similar to buying the long put. We've got that strike price that gives us the right to sell stock. That gives us that exit price. But the short put mitigates the cost of that strategy. It reduces that cost. If I buy a long put for $3 and that gives me the right to sell stock at my strike price should shares drop all the way down to zero, I could sell another put against it to reduce that cost. You know, maybe I sell a further out of the money strike put for $1. Now my overall risk on the trade is $2 rather than $3. So I just reduced my risk by what, 30%, 33%, and reduced my upfront costs by the same amount. But at the same time, it's going to limit my protection. Now my protection is only going to be between my two strikes as opposed to between my long strike all the way down to zero. So that assignment risk, our long put can cover, but the result would be one additional day. Now, what I mean by that is if I get assigned on that short put and now I'm obligated to buy shares, which I certainly can do, but then the next business day is when I would go ahead and exercise my long put to be flat that stock position. So here's an example. We're long 300 shares, $95 a share. We decide to purchase the $80, $90 put spread for $2.60, and we're looking to do 3 contracts because we're long 300 shares of stock. Profit and loss scenarios here, you can see we're long shares from 95, so if stock remains as it is, our put spread is going to expire without value. We're going to lose that $780 that we paid. Our stock position is going to be flat, and here's our profit and loss. If stock prices go up, which is, again, what we're looking to do, right? We're bullish but cautious. We want those share prices to increase. Stock prices go up. We don't need that protection that we purchased, but we do still profit on the stock position, et cetera. Now, here's where it gets interesting. This is where the protection kicks in. Between our long $90 strike, that $90 strike gives us the right to sell stock at 90. That short $80 strike obligates us to buy shares at $80. So you can see our protection right here, total profit and loss, is going to be a loss of $2,280. The reason that is limited in that range is because once shares drop below our short strike, we're no longer protected. So you can see that as shares drop to 75 or 70, that our losses accrue, our losses get bigger. So the difference between the protected put and the bear put spread is right here. So this is where our protection kicks in. This is where our protection is limited. Again, we make money if the stock goes up, but if stock drops too far, we're going to continue losing money. But again, we're doing this because we forecast that stock is going to stay in the range at worst between $90 a share and $80 a share. We think that there's very little likelihood of shares dropping below 80. and we still benefit if share prices increase. So our break-even point is going to be 97.60. That's going to be where we're long stock, plus the premium of the put spread. But our maximum loss now is substantial, all the way down to zero. And then let's kind of compare the two again. Here we are. We've got our bear put spread on the left and protected puts on the right. When it comes to protection, with this example, down to 80. So basically, we're only covered down to our short put strike. Whereas with the protected put, we're protected all the way down to zero. Regardless of where share prices go, we can exercise our long put and exit at our strike price. The cost, because we're buying one option and selling the other, the bear put spread is going to be less expensive than a protected put, typically of the same long strike. Our break-even points, lower versus higher. Maximum loss, again, as I mentioned, substantially greater on the bear put spread because stock can go to zero. And while stock can go to zero with the protected put, we're covered from $90 all the way on down. And then in terms of profit potential, this is simply profit from the long shares. Because we're paying less premium up front with the bear put spread, we would generate theoretically higher returns, higher profits if stock prices increase than we would with the long put by itself. Pardon me. So let's look at a few key takeaways here. And again, ladies and gentlemen, I really apologize. I feel that I'm typically much more sharp when I'm feeling a little bit more clear and level-headed. So I apologize that this is not one of my best efforts, and you deserve better. So I apologize, and I certainly appreciate your patience. Key takeaways here: protected puts provide investors with an exit price at which they can sell stock. But ideally, the stock isn't, ideally the protection isn't needed. Think about, and here's an analogy. I don't want to equate protected puts with insurance. I know a lot of people in the industry do. I don't want to equate the two because they're two entirely different financial products, but they do have some similar characteristics. When you think about auto insurance, for example, you're paying your premiums every month or every 6 months or annually, just in case you get in an accident. But at the end of the month or at the end of the 6 months, if you don't need that protection, you're not upset that you didn't crash your car. And it kind of works the same way with the protected put or the bear put spread. Ideally, you don't want that protection. Ideally, we want share prices to increase. Protected puts can also be used to offer the investor portfolio protection. Besides just a single stock, you can use it to protect your entire portfolio. Adding a short put to the long put, which would be that bear put spread, can minimize upfront costs, but it also reduces the overall protection. It protects the investor between those two put strikes. So as long as stock stays above that short put, then the investor is going to be protected. Now, to wrap things up, the Options Industry Council, for those of you that aren't familiar with us, first off, let me say that our webinar program is typically much better than today's presentation. So again, I apologize. But we do have numerous resources on our website, including our interactive online courses at OCC Learning. We also have our podcasts and videos, webinars that we offer twice a month, and then live options help from our investor education team. And here's our contact information. Optionseducation.org is our website. Investor Education Options at the OCC is our email address. You can live chat with us on our website, or you can send us an email. We've got a YouTube channel as well as a social media presence. So please take a look at all that information.